We saw our third trading halt in just 6 sessions right at the open, a 15-minute halt with the S&P down 7%. Now, like the two other halts, it did produce a brief rally shortly after the market reopened. But like the other halts, it did not stop the market from drifting lower in the middle of the day. Stocks moved back to lows for the day toward the close, as President Trump said coronavirus may be an issue through July or August. Now, that realization that this may last longer than some anticipated again led to heavy declines in travel and entertainment stocks like Avis, Las Vegas Sands, Live Nation, airlines like United, all of which were down 10 to 20%. Since Thursday, the market has begun to bifurcate. We've noted this several times and did so again today. So we saw cyclical names in the Dow. Brian mentioned Boeing, Chevron, United Technologies, all underperformed. Consumer-oriented names like Procter & Gamble and Johnson & Johnson down, but down far less. Indeed, a small group of consumer names like Rite Aid, which said they were working with the White House task force to offer testing in parking lots for the coronavirus, as well as Kroger, Clorox, Campbell's Soup, all consumer names, they all traded up today. REITs were down across the board big. Office REITs like Boston Property, malls like Macerich, apartments like Equity Residential, even storage REITs like Public Storage got hit hard on concerns that a slowing economy would impact real estate activity despite the lower rates. So right now, Brian, the S&P is 29.5% off its historic high. That is precisely the typical bear market decline of 30%. Technicals don't mean much here, Brian, but one level, all the traders still watching 23.51. That was the December 24th, 2018 low. Brian, back to you.
What's the buzz down there on the floor of the exchange, Bob? Obviously, there is a debate, and I'm hearing it from people like, don't talk about closing the market. You're going to scare people even more. It's irresponsible. Stacey Cunningham had to come out and address it because, like it or not, agree with it or not, the conversation has been out there, has it not?
Yes, and they're not going to close the market, so it's just not going to happen. I mean, the big guns have been dragged out in the last 3 days. Secretary Mnuchin on Friday specifically asked, no, we don't want to. Tracy Cunningham said to me in an interview, she said today, no. We had Terry Duffy from the CME on. We had some people from Nasdaq speaking about this as well. All of them agree none of this would serve any purpose. What would it do? It may continue to erode investor confidence overall. So Stacey's right. You want access to your money, and we'll get through this. But closing the markets will produce a lot more problems. Also, there's a simple practical problem of how do you exactly do this when the global markets exist. There are other ways to play U.S. stocks using foreign European ETFs, for example. It would effectively not really stop speculating in U.S. market activity.
So basically the markets, even if they thought about it, the markets with 11 different exchanges in the United States alone are too dispersed. They're too interconnected. They're too computerized. There's no way to shut it down.
It's not that there's no way. If you could have an agreement to do that, it would be fine. But what would be the practical effect? It would probably further erode consumer confidence. It wouldn't allow people to have access to their money. And globally, there would be other ways to play the U.S. market to effectively short it, using foreign derivatives, for example, and even ETFs that exist. So it's not a practical way to do things. And ideologically, it's not a good idea either. I happen to agree with Secretary Mnuchin as well as Stacey Cunningham on this.
Fair enough. Listen, as long as everybody can actually work and do their jobs, because they're all at home now, we'll see. Bob Pisani fighting the good fight down there at the NYSE. Okay. Bob, we're glad you're there for us. You've seen it all. Thank you very much. All right, let's turn now to D.C., because the president's saying today that we may have to live with this virus outbreak through the summer. The market sold off another 1,000 points on those comments. Eamon Javers is live for us in D.C. with the late-breaking details on that side of the story. Eamon.
Yeah, Brian, the president this afternoon giving us a much stricter set of guidelines from the federal government, suggesting that no gathering should happen of more than 10 people anywhere in the country. All students across the country should stay home from school. All Americans should stay out of bars, restaurants, and even food courts, Brian. This, according to the president of the United States this afternoon. Much different guidance than what we got just yesterday. The CDC said no gatherings more than 50. Today, down to just 10 people in that overall ranking. And Brian, I'm going to toss it back to you here because we just lost audio here from our temporary connection. I'm going to head back to you because I won't be able to play the soundbite here. Back over to you.
All right, Eamon Javers in D.C. If we get that back up, Eamon, we will certainly bring in back everybody. Eamon Javers, that's kind of like what we're all dealing with right now, folks, just like you are dealing with as well with Wall Street. Everybody's trying to sort of makeshift these things happen. And we'll see what happens. All right, let's now bring in Guy Adami. Guy also made the trip into New York City tonight for you, and we are at a socially acceptable distance away from each other, Guy. All right, Guy, you are a 30-plus year pro. Had you ever imagined that we would see a few trading days like the ones that we have?
I'd be lying if I said the answer was yes, unfortunately. No. The short answer is no. And look, the Dow Jones is going to do what it's going to do. I get it. And tomorrow, for whatever reason, we could be up the amount of points we lost today, and that's fine. But as I've said now for a while, and I think you know my feelings on this, my real concern, and I think a lot of people are coming to the realization that the moves in the bond market do not make sense. I mean, there's no way the U.S. 10-year note should move 0.5% in a day, let alone 28% in one day, 50% in one day. I mean, the moves we're seeing are not normal. But that's not true just over the last couple of weeks, Brian. That's been true virtually since September and earlier than that. So, you know, the real concern, and I think people are starting to see that, is in the bond market. So if we can get a handle on the Treasury market, and you know maybe that's what's being attempted now, then maybe things can slowly sort themselves out. So I understand why we would be focused on the 2,000-point moves, because they're obviously headline makers. But the real under the radar thing that's becoming on the radar thing is the Treasury market.
Yeah, were you pleased at all? Let's try to find a little bit of a silver lining here, Guy. The 10-year yield is kind of held up.
I don't know how to answer that, and I understand the question. I will be pleased when you start seeing, instead of 5, 10, 15, 20% days, when you start seeing it move less than 1%, so we can get some stabilization at whatever that yield is, and then maybe there's some semblance of normalcy that's coming back. But to say that I was pleased with the fact that 10-year went from wherever it closed on Friday, I think either side of 1%, to where it closed today, I think, 72 basis points or thereabouts. That doesn't give me a lot of, it doesn't assuage my concerns, let's put it that way.
What would?
As I said, a few weeks where instead of seeing these wild volatility swings in treasuries, we see some stabilization. Now, as I said, the stock market's going to do what it's going to do. We've thrown out levels now for weeks. I think it's somewhat of a fool's errand to try to do that now, although, as a lot of people have mentioned, that December low is obviously right in the crosshairs for those that are interested. But what would give me some hope, and hope is the right word, is a stabilization and less volatility in bond yields here in the United States.
We look at the bond market and all these instruments now, Guy, that are out there, all these ETFs, the JNK, the HYG, there's really hundreds of them that are designed to be liquid, but we know the bond market is not that liquid, especially now. You talk to bond traders, I'm sure you do during the day, I do during the day. They're not able to necessarily find prices everybody agrees on. Let's just keep it that way. Do you think the bond market is still going to be having some problems over the next couple of days? Yeah,
I do think that's okay, though. It's going to be rough sledding over the next few days, without question. It would be foolish of me to say otherwise, but it will find its footing if the powers that be allow it to. In other words, I understand now, drastic times call for drastic measures. I get it. But there's going to come a point where you have to allow the market to find its footing on its own. That might be painful, but I think a lot of people are learning that might be absolutely necessary.
Yeah, and I think that's what we are finding out right now, is that the markets still have yet to find a floor. Do you have any indication, Guy, of what that floor may be? I know our friend Scott Minerd came out earlier today. I believe he's on the 7 o'clock special tonight as well, saying he could see the S&P going down to 1,700. That is lower than pre-financial crisis highs.
Yeah. Well, if you want to sort of map it out, and I'm somewhat reticent to do it, but I will. If you recall, obviously everybody knows that March 2009 low was 667 in the S&P 500. Obviously, the recent high was right below 3,400. I think it was 3,393. So if you're looking to play in terms of levels, a 50% retracement of that entire move gets you around 2030. So if you're asking me, that is a level that we could see. And quite frankly, given the volatility we're seeing, that's absolutely in the crosshairs. I'd have to look and see what 1,700 represents to get us there. But I think, you know, if you're really looking for then an absolute level, that 50% retracement of effectively the last, 11 and a half years or so, makes sense.
Is there any, we've talked about these things that I like to watch, the BKLN, which is the bank loan ETF, some of those bond ETFs that I referenced. Those are the things that I'm watching a little more closely than just the equity market, because equities are kind of coming down altogether, with the exception of a couple of grocery stores and Clorox and Campbell's Soup. Is there anything, Guy, aside from the 10-year yield, that you're going to advise our audience that they need to be watching closely every single day?
Yeah, and the things we've talked about, I think the HYG is a fascinating indicator. I mean, I think that's something that if you want to put something to high yield, put that on your screen. People will say things about the TLT. Maybe the TLT is broken, but I think in terms of a barometer for what's going on in interest rates, you should have that up on your screen as well. And the last one, for what it's worth, and this is something I know Dan Nathan has talked about, Tim Seymour, we've talked about it literally since last summer, but the Russell as measured by the IWM, and we said it, it never verified, it never backed up that move in the S&P 500. So underneath the move in the broader market, the Russell was trying to tell you something as well, and obviously that's breaking down. And, again, it's not the time for kudos, I get it, but, Carter Worth, to his credit, was pointing this out as well. The problem is when the market goes up every single day, when you try to point out the potential pitfalls, I'm not saying it falls on deaf ears, but people just see what's going on in the broader market. Sometimes you got to look under the hood, and I think that's what people are sort of learning right now.